Hi guys, and welcome to my YouTube channel. In this channel, we talk about all things personal finance, understanding all the financial investment vehicles that are out there, making sure that we rightfully use them towards our goals and ultimately achieve that financial freedom. Okay, so today I have an exciting video. I'm going to be reviewing my tax-free savings account portfolio, speaking about what I have, what has worked, what has not been working, what I will be changing going forward. As you all know, if you're coming back, you know that I am an advocate for a tax-free savings account. And if you're new, here we are. I am an advocate, a strong advocate for tax-free savings accounts. But before we can get into the topic of the day, please make sure you subscribe, guys. I really appreciate it. Just click that subscribe button. I am on the road to 10,000 subscribers, and I would truly appreciate it if I can journey that with you. If I can get there with you, I would truly appreciate it. So today I'm going to be reviewing my portfolio, like I said, specifically my tax-free savings account, and I'm going to just be telling you guys what has worked and what haven't worked, and actually just speaking about the ETFs that I have and where I'm standing with those particular ETFs. Okay. So I started my ETF journey or my tax-free savings account journey in 2020. So it's very important to highlight to you that the tax-free savings account was only introduced in 2015. So meaning that in 2025, it's only now that it's turning 10 years. So this is a very young account. It's a very young investment strategy for South Africans. I know that other countries have been benefiting from this. And now for us, it's only been 10 years, meaning that anyone who have been working for a while, but, trying to invest and not figuring out which product works for them didn't get to benefit from this. But us, the younger generations, we have an opportunity to maximize on this even when you're older. If you're looking into something to do that you feel like can really benefit your portfolio, this one I advocate for it strongly, right? And I started my journey in 2020, so I'm only going to 5 year in 2025. I think this would be my fifth year of contributing towards my tax-free savings account, and I have not always maximized my tax-free savings account, especially in the beginning, because I was still trying to figure out what works and what doesn't. However, in the last 3 years, I know for sure that I've maximized my tax-free savings account. And this doesn't necessarily mean that for you to invest on a tax-free savings account, you need to maximize it. And the maximum, just a reminder, I have a separate video where I elaborate in details on what a tax-free savings account is and what the principles are. So please check that one out before you come here so that you can have an idea of what we're talking about. So the maximum is 36,000, but you are allowed to contribute any amount less than that. And I think in the beginning, first 2 years, that's what I did. I just contributed what I have, but of course without exceeding the 36,000. So my account is, fairly young, but now I believe I've figured out how it works and what I want to do with the account, and I'm just sharpening and redefining my strategy as we go. But for now, I think I know what I'm doing here. I've maximized my account for the last 3 years. I'm still planning to maximize it until such time when my 500,000, which is a lifetime contribution, is reached, and I'm looking forward to that. If I could fast forward and contribute double for 1 year, I was gonna do it, but unfortunately we are only limited to 36,000. So currently my account has 165,800, and that is how much in total I have on my tax-free savings account, and the growth on that is 20%, with the profit of 28,000 100, right? It's very important to note that this view that Easy Equities gives you, it's not annualized, meaning that you don't have 20% year on year. That's just your overall growth. The unfortunate part is that sometimes this amount is not even inclusive of the stocks that you have sold at a loss. So it's not a fair way of viewing the performance of your portfolio. For me, the best way to see the performance of your portfolio is to go to statements and actually see annualized what has been your year-on-year growth since the time you started, because that's where you see what the money you've contributed into that particular account versus the money that you have grown in that particular account combined. What does it look like? How much have you made in total and how much have you lost in total? It's very important to just use that method, and your statement, which you find on Easy Equities as well, will be able to give you that view. So just try to do that. I will have a tutorial on how to access it and how to read it in another separate video. So you get to see these statements, and for all accounts, whether it's your ZAR, your USD, or your tax-free savings account, you get to see it there. So check it out before I can create the tutorial, and then you can familiarize yourself with what it is. Right now, getting into the video of the day. I'm sorry the intro was a little bit long. I will be highlighting what ETFs I'll be keeping, because there are some that needs to go. So I'll talk about what I will be keeping and what I will be letting go. And of course, I'll start with what's not working, because this is where I have fair amount of details in terms of what I want to do with those ETFs. So I'm going to start with the red and the greens. I know you guys look at your portfolio that way. You're like, I'm green on this and I'm red on this, So I'm going to start with the ones where I'm red, and I'm going to talk a little bit about them, on why I even added them and why I might be letting go some, or why I might be keeping some. It's worth always reviewing if the ETFs that you have chosen are still working for your portfolio, and make amendments as such. Like I said, I feel like at this point, I am at a point where I know what I'm doing, so it should be easy for me to know what should go and what I should be keeping, right? So to start with, I just want to give you a list of the ETFs which are currently on red. Firstly, let me tell you the number of ETFs I have on my portfolio. I have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. I believe I have 13 ETFs, right? So the first thing that I can say with that is, I just want to confirm from the app that I have 13. The first thing that I can say with that is, you do not need 13 ETFs, guys. You do not need 13 ETFs. 13 ETFs is a lot, right? So what will happen is that you will experience things called over diversification. This is where you have growth in some stocks or ETFs and losses in some ETFs, and then yet you're not seeing any progression in your overall account. It happens mostly when you're just too spread and there is no some sort of consolidation in terms of where you should be growing. Where you're losing too much. Where you're growing too much. So it combined is just a zilt, right? So be sure on what you need to keep in your portfolio, but I would say a maximum of 5 is enough when it comes to ETFs. So I will be chopping down going forward into my 2025. I will be chopping down some ETFs just so I can minimize them. Of course, I won't get to 5 right away, but there are some that I'm going to definitely cut off. As I'm talking to you in this video, I've already decided some that I'm going to cut off. So I will be maximizing my tax-free savings account for 2025 very soon. So before I start purchasing the not new ETFs, before I start topping up on the ones I have, I will start by cutting down the one that I feel like are not aligned with my strategy, and I'll be telling you what criteria I use to do that. Okay, so just to confirm the number I have: 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. Yes, I do have 13. So I have about 7 to consolidate. But yeah, to be honest, you just need 5. You just need 5, and you just top up on those. And that's the reason why we do ETFs instead of buying a lot of individual stocks, at least for me, right? So let me start by just giving you where each one of the ones that are red are sitting, and then I'm going to give you feedback in terms of what I'm going to do with each one of those. So starting from the highest loss, I have the Cetrix DV Plus, which is sitting at minus 6.7. I also have Cetrix Resi 10, which is sitting at minus 5.9. I have MSCI India, which is sitting at minus 5.4. I have MSCI Japan, which is sitting at minus 4.8. I have Euro Stocks 50, which is sitting at minus 1.5%, right? This is within my portfolio. It's not the performance of the ETF. It's the performance of my ETF. This is dependent on when I bought the stock and what happened since the time I bought the stock. So these will not be the same as what you see on your account. Okay, this is mine. It's my performance based on when I bought it, right? If you want to see how each one of these ETF is performing, you will have to look into the fact sheet and see the performance of the specific ETF from there. And that will be the driving force of what I decide to do with each one of these ETFs that I've just read to you. So now let's talk about DV Plus, because this is the first one that has minus 6.7, if I believe, overall loss in my portfolio. So when it comes to DV Plus, is that it has a lot of mining companies, because mining companies are the ones that pays dividends. Actually, the DV Plus ETF, it's an ETF that focuses on paying dividends. So a lot of people who are investors probably have this ETF, because when people are investing on ETFs or stock market, one of the things that excites them is dividends paying ETFs, dividends paying companies. Whether or not that's the right strategy, it's for you to decide based on what you want from your portfolio, right? However, for me, I'm not a dividends craze person. I'm not chasing dividends because I feel like that's not the strategy that is aligned with what I want to achieve, simply because most of the companies that pays dividends in terms of growth, they are very stagnant. Hence, a DV plus ETF would have such a negative performance overall, right? So if you look into these DV plus ETF, the top 10 underlying companies are Exaro, Investec, Tungela, Absa, African Rainbow, Kumba Iron Ore, British Tobacco, Nedbank, Old Mutual, and Truworths, right? So I already have Exaro as an individual stock in my portfolio, in my ZAR account. I also have Tungela. So because I have a mining background, I'm a little bit biased in terms of mining companies. So I'm more leaned towards buying mining stocks, especially when it comes to individual stocks, because the thinking or the subconsciousness believes that I understand that market better than most, therefore I would know if things are not going well. For an example, the mining industry is going through bad cycle right now, like things are just not going well for the mining industry. Specifically in South Africa, the machines that are parked, they're operating at 50-60% of the full capacity. The railway lines are not working, so there is really a lot. The commodity prices are bad, in different type of commodities of the mining sector. So mining is not doing well overall. So hence, if you see something within your individual mining company being red, should not be surprised, right? So for me, that biasness is there. Hence, I'm most likely to have mining companies. However, I'm trying to be aware of my own biasness and fix it. So therefore, this DV plus ETF that has majority of mining companies, I am going to sell. I'm definitely going to sell it, and I'm going to try to figure out if I need to sell it immediately after, or should I wait until such time when I want to maximize my tax-free savings account for 2025, and before I buy, I need to sell this one and redistribute amongst the ETFs that will be left. So I'm going to sell it simply because I have other individual mining companies that pays dividends that are on my ZAR account. I don't need a dividends paying ETF in my tax-free savings account. That's just me. However, looking into the performance of the DV Plus ETF, in the last year, they performed at 3%, which was 2024. In the last 3 years, annualized, it was 3.4. In the last 5 years, it was 8.9. In the last 10 years, it was 7.03. So in a way, like I said, majority of the companies are mine. Things are not necessarily looking really good, because what is 3% per annum, guys? That's literally nothing. And minus the service or the management fee, you're left with 2% there, right? So I'm definitely, selling this one. So the second one that shows me flame, or that's making my portfolio not to be as how I want it to be, is the Resi 10. The DV Plus is the one that pays dividends. The Resi 10 is the one that have resource industry. So you see duplication over diversification. DV Plus, in as much as it focuses on dividends, majority of mining companies pays dividends. Therefore, it has majority of mining customer companies in it, right? And Resi 10 strictly focus on resource industry, so it's mining industry again. So before I can even tell you the details of this ETF, I am definitely selling out of my portfolio, it's out, so I'm removing this one as well. So it has the likes of your Goldfields, your Anglo-American, Anglo-Ashanti, Harmony, BHP, etc. So I do not have these individual companies in my ZA account. However, I have other companies in my ZA account that are mining companies that focuses on the same commodity that these companies focuses on. For an example, BHP has gold and I own Sibanye Gold, which has gold. So I cannot have both BHP and Sibanye in my portfolio, one on my ZA account, one on my ETF. So I'm definitely letting go of my RESI 10 as well. I do believe that the mining industry will recover. So the companies that I have on my ZA account will be the ones that shows me the benefit of keeping the mining industry within my overall portfolio, not with my ETF. So I am definitely going to sell this. Okay, so the other three ETFs that are not performing well, that are on the red, are ETFs that I've recently added. I think I added them in 2024, and I think I have a video of me explaining why I added them. So I'm not even going to talk more about why I added them, because there's a video of me talking about 3 ETFs that I'm adding to my portfolio, and that is the MSCI India, the Euro Stocks 50, and the MSCI Japan. So when I did this, I was trying to have my portfolio to be diversified geographically, right? So in my video where I spoke about description of ETFs and what they are, I did speak about ETFs can be diversified by geography. You can have ETFs from the country in which you're based. For me, that's South Africa. You can have US ETFs, Australian ETFs, European ETFs, and so forth, right? So when I looked into my portfolio last year, I realized that I only have South African and US, right? I only had South African companies and US companies, even when they were in different industries, but it was only with these two countries. So I made it a point to say, let me look into other countries and look into ETFs that I can buy from those countries, right? So the countries that came up was, or things that I was thinking about was Asia exposure plus European exposure. Those were the two things that I was looking into, and hence I ended up adding the Euro Stocks 50 plus the MSCI Japan plus the MSCI India, right? Now let's talk about what is actually happening with those, okay? So with the MSCI India, oh, Jesus, guys, Jesus. So this one, I will definitely keep it because I think it's just me buying at the wrong time. This is relatively new ETF that Cetrix added to their portfolio of ETFs. And last year alone in 2024, it achieved 13.9%, which is good considering that I had minus, let me check, let me confirm. MSCI India, I had minus 5.4, so definitely bought it at the wrong time. However, the ETF itself annualized in 2024 was at 13.9. That gives me confidence to say there is hope in terms of what it will achieve. And also, I still want to have, some sense of Asian exposure when it comes to my overall portfolio, so definitely keeping. The one that I'm not sure why I actually did buy it is MSCI Japan. I actually feel like I bought MSCI Japan before MSCI India, but when I compare the benefits, then I realized that MSCI India, or when MSCI India was introduced, then I realized that it's better to keep MSCI India in my portfolio than MSCI Japan, right? So, but at this point, I'm not sure if I need to look into another ETF that will give me Asia exposure than just either Japan, India, Australia, or China. APD, it's Australia in Asia. Anyway, yes, so I think I'm looking for a holistic view of Asian ETFs than me picking and choosing by country. That's just a lot, so I will look into consolidating the two. If not, I'm just gonna get Japan out of the way. So by the time in which I start buying new ETFs for not new, when I start topping up, I need to erase that word new because I'm only topping up, I'm not buying something new. So when I do the top up for my 2025 maximizing of my ETFs, I will make a decision to say, am I consolidating all the Asian ETFs, and am I looking for one that will give me that overall view, or am I just going to let go of Japan and keep India, because it's not happening. So in terms of performance, when it comes to the Japan one, it's doing better actually than your DV Plus and your Resi 10, because last year they did 6.1%. In the last 3 years, annualized 5.6. In the last 5 years, 7.6. In the last 10 years, 9.4. So there is a bit of hope there. However, I feel very over diversified by just having, every country's ETF. What are you going to do? Have every ETF for every country? That doesn't make sense, right? Also, considering that I have total world from 10x, which is covering 1,100 global countries. So that gives me like total world, full global exposure, with different companies from different regions and different countries. And I know that majority of companies within that ETF specifically that I'm talking about, they're from the US. So I'll see what I'm gonna do. As you can hear, I'm yapping simply because I'm conflicted when it comes to these ETFs specifically. Lastly, on the one that's giving me a loss, and don't worry, I'm still gonna talk about the ones that's on the green, because I also have the ones that are making sure that we are rightfully using our products to financial freedom. Okay, so Euro stocks in terms of performance in the last year 4.8, last 3 years annualized 7%, last 5 years 10.2, last 10 years 8.1%. So this one definitely a keep. It gives me exposure to European companies, so I'm definitely keeping it. It's top 50 companies by market capital for emerging and large. Emerging and what? Yeah, well, you get my point. So I'm definitely keeping it. So I'm gonna give you a list of the ones that are doing well, plus the percentage of growth that I have on my tax-free savings account. And in addition to this, I'm going to create a separate video where I'm going to talk about 5 ETFs that have achieved more than 15% annually in 2024 that are in my portfolio. So you should look forward to that one. If you have watched until here, please give me a white heart. Let's confuse those who didn't keep up on the video. So in terms of the ones that are on the green, I have 10x, which is at 49.8%. I have S&P Information and Technology, which is at 42.6%. I have the top 40, which is at 21.3%. I have the Fin 15, which is at 22.2%. I have the healthcare. I believe this is from Cetrix. It's 7.5%. I have MSCI World ESG, which is at 29.7%. I have Nasdaq 100, which is at 62.1%. I have healthcare, which is at 15.5%. Remember, these are my growth, not necessarily the ETF's growth based on when I bought it, right? So what I can say here is that I can clearly see that when I am exposed more in American stocks, that's where I'm achieving growth. To be honest, I'm still young and I want to lean more on time and market correction and compound interest to play on my behalf. I am not about to keep an ETF that is not giving me growth. So I am going to go aggressive, meaning that I'm going to contribute more on ETFs that I know that they have a potential to give me more than 10% growth year on year, meaning that I'm going to have less exposure to South African stocks and more exposure to foreign stocks. The reason why I say this is considering the fact that I also have my government, my pension fund, sorry, not government, my provident fund, which then has a regulation 28 in it, which stipulates that at least 40%, only 40% of my investment in my pension provident fund should be invested in foreign investment. that is limited for me. 40% is very low. So I will go heavy in my tax-free savings account, and then understanding that at least my why am I saying resource industry? My provident fund then is invested more on South African companies because of the regulation 28. So I am going to go aggressive in my foreign stocks investment, and that is my strategy. And I'm definitely going to consolidate and reduce so that year on year, and when I top up, I can only buy fewer ETFs. And if I can reduce it to, at least the target for 2025 is just to reduce it to at least 8, meaning that 4 needs to go, 5 needs to go, because I'm sitting at 13 right now. So if you've watched until here, give me 2 hearts, then I know you mean it. Don't forget to subscribe, like, and comment. And also don't worry about the ones that are performing well. I will do a separate video only highlighting those that have achieved 15% annualized performance in 2024. Goodbye.